great future. We're talking real money.
You know, you gotta think for a minute. Like, if a third of the population in the country is of above average intelligence and a third is about average intelligence, that generally you're going to have about a third who are sporting below average intelligence. Now, I'm not saying you're one of them, because you listen to the show, you're probably not. But I bet you know some people who you think, gee, they may fall in that third. And, well, there are a third of you who believe something that is absolutely, totally wrong. Hi there. Welcome to Talking Real Money. I'm Don. That's Tom. On the screen from his house, and the quality is just terrible.
Yeah, they're still working on getting the internet out here. They're talking
so
2030 or 2035.
You know, the string works surprisingly well for audio, but not very well for video.
It's just the end of the road. I mean, that literally is the end of the road. You literally are the end of the road. There is no going from here.
We would like to spend some time telling you about money and talking with you about money, and it's so easy to communicate with us. All you have to do is call us on Saturday, like today, at 855-935-TALK, 855-935-8255. We'll talk about your money stuff, particularly investing stuff, and maybe set you straight when it comes to certain investments. What was I referring to when I said a third of you like something? Some things.
It's more than a third.
Well,
if you add the two top things together.
Right. A third of Americans, a third believe real estate is the best long-term investment. And then there's gold,
which they also more than a third. You add the two of them up, and it's 7 out of 10 Americans that believe that gold and real estate are the best long-term investments.
So it's only the highly above average intelligence people who actually know the fact that it's neither of those. Long-term.
Not even close.
Not even close. I mean, I got the numbers over 100 years. 100.
Okay, hit them. What do you got? Let's just add in the rest of this, because
go ahead.
Stocks 16%. I think that's 1 out of 5.
16% believe they're the best.
Yeah. Exactly.
Wow, it just goes to show you how wrong we are about our facts. We really don't know as much as we think we know, but we do like to believe that we do. Okay, what is the best performing of those three asset classes? Stocks, real estate, or gold? Well, I went back 100 years, almost 100 years, to 1928. It's the farthest back I could get all the data. U.S. real estate, average annual return. This is not after inflation, before inflation.
Does not include leverage, by the way, either.
Nope, just the return, 4.2%. So $100 invested in 1928, by the end of 2024, would have given you just under $5,400.
And I want to make sure you slipped it in very, very quietly. That is not a real rate. That's the rate before inflation. So after inflation, it's about 1%.
Yeah, all these rates I'm going to give you are before inflation, so it's a fair compare.
So 1% above inflation a year.
So that's what a third of you believe is the best. Then another third of you believe gold. Okay. The average annual return for gold, 28 to 2024, about 5% per year.
Okay, so there you get 2% above inflation.
So that's a $100 investment becoming $10,000.
Okay.
Double real estate. Oh, so that third with real estate, well, the gold people beat you. How about the stock people? Average annual return, 1928 to 2024, 9.9%. Means $100.
That's a significant difference.
Means $100 became not twice as much as gold. No, not 10 times as much as gold, but 78 times as much as gold, or $787,000 on $100.
And that is just an index of the largest companies.
That's the S&P 500. Yep.
Yeah, you didn't need to hire Warren Buffett for the last 98 years to make way more than the index. You just had to own those stocks.
No.
Fascinating. By the way, gold hasn't been this popular since, guess when?
1980?
2011.
Oh.
No, 2011, when the last major crisis, I guess, was. with high unemployment, crippled housing markets, volatile stocks, etc. So there you go. That's why.
So when are people going to admit they don't know as much as they think they know? We'll be back. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Hi, everybody. I'm Don. That's Tom. This is Talking Real Money. I'm in Florida. Tom's in Seattle. Well, loosely. We can say Seattle. Loosely.
Seattle, the greater Seattle area.
He's in the state of Washington. We can say that with certainty. By the way, what?
You were not here last week, and people asked me what was going on.
Oh, I should probably explain, shouldn't I?
You probably should.
All right, let me explain before we go to the phones. I have a genetic predisposition to arterial fibrillation or AFib,
among other things.
I got a lot of but this was a relatively serious problem because it can cause stroke. It can cause clots and strokes. So I was on drugs for it, and I was going to go in to get an ablation done on my heart where they zap it.
Which, by the way, I volunteered to do for you free of charge. My father was a physician, as you know. But.
Yeah, and you know what happened to you in the family there, you black sheep. Anyway,
you went.
So
in.
I went in.
Yes.
It was an outpatient procedure. I went into the hospital. They knocked me out, put me under. Then they put a little ultrasound device down my esophagus.
TMI, we need to get on that.
Well, but they went in and they looked around and they went, oh, we can't do this.
Because they found, you didn't want to tell them why, that you're the world's only living heart donor. Isn't that what they figured out?
I got to get you new writers. I'm working on hiring you a new writer. I'm really working. Because I think you've used that joke.
Oh, I'm sure at least maybe a half dozen times.
I wasn't able to get the procedure done.
No, we're all glad you're feeling better.
I was going to be out for a while, but it had already been set up, and
we're glad you're
from the anesthesia.
I'm sorry it didn't work out, though.
But it didn't work out.
I'm sorry it didn't work out. But I will say this: at least when I missed you missed the show for like silly little thing like heart surgery. At least when I'm not here for the show, it's a 5-star vacation. At least I got the priority
and it
straight.
Is literally a 5-star vacation. Whereas,
I haven't used that one before.
Whereas I'm taking a brief vacation this week to go to my daughter's grad school graduation.
True.
And guess where I'm staying? What kind of hotel I'm staying at in New York?
God,
for
$1,000 a night or whatever it is.
It's a Town Place Suites by Marriott.
Okay, $700 a night.
Actually, I got a deal. I used some points, and I got it for only $300 a night.
Oh,
jeez.
Wow! That's
hotel rates
crazy.
in New York. I was looking at Marriott's app, and there was one that was $19,000 a night for one of their hotels. 19. That was the best rate. I'm not joking. 19,000 a night.
000. Wow. That's crazy.
855-935-TALK. That is our telephone number. Give me a call. We'll talk about money mainly, but anything that involves money. And by the way, my non-surgery was still very expensive, so it involves money. And we do have a call awaiting us, which is a good thing.
Okay, let's get to it. Sure.
It's Jim in Allentown. Hi, Jim. Welcome to the show.
Hello. Hi.
Hey, what's up?
I've enjoyed your show for a couple months now, and finally calling in with a question. I have a traditional 60-40 portfolio, and I'm very disappointed in the performance of the bond side. So I was looking for something else, and I was looking into this multi-year guaranteed annuities, which seem to have some good things that mirror CDs in that they come due in 3, 5, and 7 years, and they have a fixed rate, and you can get a little bit of your money out every year, even if you needed to. And I just wanted to get your take on this to see if it was too risky or if it was something that might take some of the bond side of my portfolio.
Well, before Don gets into the specifics of all this, I would not compare that security, using the term loosely, to U.S. Treasuries. in terms
or
of
CDs even.
security. I mean, you can't even put it in the same universe.
Well, you can.
One's guaranteed
you can put them in
by
the same universe.
Yeah,
you just
but
can't put them in the same galaxy.
Yeah, okay, but one is guaranteed by the U.S. government. The other one's guaranteed by fill in the blank XYZ
by an insurance company.
Right. Yeah. So no, I couldn't equate this in anywhere near the same. No.
Yeah, because we know from history that insurance companies have gotten into trouble and have essentially defaulted on their promises. It happened with a company called Executive Life several years ago, many years ago now. But insurance companies are really the insurance guarantee is only as good as the company. Yeah, there are some state pools, but in a disastrous market, they won't. Well, they won't. They can't be as secure. They cannot.
Okay, but
be
let's
as secure.
I want to go back.
But
Jim,
that's in the rates. There is no magic formula for getting you a higher rate of return that doesn't involve you somehow taking higher risk. It's absolutely essential in the marketplace, given the efficiency of that marketplace.
And what you're really saying is you haven't made enough money in bonds, and so you're disappointed with the return. Is that what I'm hearing?
Yeah, yes, it's been so flat the last 5 years that I'm looking at, they do rate them AAA, AAA minus. They do rate the different levels of annuities.
But let me give you,
so a little bit of a guide there.
Not really. Let me give you an analogy. Remember, let's go back to 2008. Do you remember a thing called collateralized mortgage obligations?
Right.
They were in the news. Many of those had AAA ratings and yet defaulted on their payments because the underlying securities that were backing them turned out not to be as. Remember all the rating agencies getting into trouble because they rated them AAA and then they found out they weren't as safe as that because in part they were in cahoots with the people who created the securities. You don't think the insurance industry has some incredible power over those who rate them and that their ratings could be wrong? I just don't trust it unless it is full faith and credit of the U.S. government. But as long as you understand that those higher returns mean higher risk, I guess it's what kind of rate are they quoting you, though? I'd like to hear what the rate is because I'm looking at some online.
An average rate. Yeah, not the best rate, but an average rate. Many companies sell them like about 5.8 for 5 years.
Yeah,
the catch is that if you do want to take all your money out, you do take a stiff penalty up front, unlike a CD where you would just lose the interest on the CD.
And that catch exists for a very good reason. You know why the surrender charge exists? It's to pay back the commission paid to the agent. So they have to hold that money. Now, if somebody is paying out 5.8%, let's assume for just a second that it is absolutely as safe as U.S. Treasury securities or CDs. We're just going to make that hypothetical assumption right now. Where would all of the money in the world that wanted safety and high yields go?
Right. Makes sense.
Mine would go there, too. You could be sure of that.
I guarantee you we're not stupid. Yeah. Tom and I have been in the money business for a very long time, and if I really believed that these annuities were as good as the salesperson claims they are, now remember, annuities are sold. Rarely do people go out and, I'm just going to go find me an annuity because they pay very nice commissions. If I truly believe that they were comparable to a CD or a Treasury, I guarantee you I would have all of my fixed income money in these annuities, and I have nothing in them.
And I would also go back, Jim, to the purpose of bonds. Those should be for stability in your portfolio. I think you're looking at them incorrectly here. Why aren't they making as much as stocks?
They'll never make as much as stocks. And the fact that they're flat is part of what you get, but it's expected.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Let me give you our phone number again because I know it's hard to remember it. And you're driving or something. So I figure if I say it enough, you can't forget it. Maybe I should create
I forget
a jingle.
it sometimes.
855-935-8255.
That's pretty good.
Or talk.
Yeah.
855-935.
There are other ways to send us questions as well. You can just go to the website.
You go to talkingrealmoney.com. You click on the contact form. And then it comes to us either typed or spoken. If it's spoken, I do them on Friday in Friday's podcast. If they're typed, then you get them whenever. Could be anytime. We never know. Like, well, we're going to do one right now, aren't we?
Yeah, but we do take them in the order of which they were received. So this one came in a while back because we've had a lot of questions lately. And this comes from Davenport, Florida. From Jim.
That's really in my neighborhood.
He actually says in his note he can look out his deck at your house sometimes.
Well,
so
no,
he's very excited
I can't
about
see
that.
Davenport. There's a highway.
Oh, okay. All right. He says, I'm currently working for a large theme park located in Don's backyard.
I wonder who that is.
They still have pensions. I started with a company late in life. Will be putting in approximately 12 years. When I leave, they will offer me a lump sum of approximately $37,000 or a monthly check of $250 for the rest of my life. Is there a rule of thumb on what to do? Should I roll over the lump sum into my traditional IRA or treat the $250 as monthly Epcot beer money? I wonder how far you can't even get in the park for $250, right? I mean,
yes, you can. You can off season.
There was a piece in the Journal today, but
off season. It's like $100 and some odd bucks, $130,
and it's about 100 and something degrees outside too.
And then that what they charge for beer. That's a 2-day
There's
pass,
the $250.
a 2-day pass, and a
Half
1-day pass and the beer. Yeah, you're pretty much done for. How did he say how old he was?
62. He says I will be 62. He doesn't say.
So he'll be 62 when he's taking the money.
I guess, yeah.
So
$37K or $250 a month.
Hold on. I want to do some. See, I didn't get this before, so
no, we don't share. We try to make life as hard on Don as we can, as you know.
So
that's $3,000 a year.
How much was it?
$3,000 a year or $37,000.
No. It was 37. Okay, is the amount of money we have to deal with. So,
but I can make you a guarantee before Don even runs the numbers that taking the money out, investing it, and living off of that, you'll end up with more money than you would taking the $3,000 a year set from the pension, because there's no inflation with that, right? There's no growth. There's no flexibility. So financially, most of the time, it turns out to be a better decision to take the lump sum, invest it properly, and then take out the money you need to live on.
Yeah, because
most of the time.
Because here's the deal. You could take out. What was the payment? It was $300 a month.
$37,000 or $250 a month. Yep. Mm-hmm.
$250 monthly. You could do that. You could take out the $250. Oh, well, hold on. If he takes out the $250 monthly,
yes,
and he
$3,000 a year,
5% on the $37,000, the money will last 20 years. So actually, you see if you're needing the income from it, then it's not the lump sum may not be the best case scenario. If you
more flexibility, the money's yours, et cetera. There's other reasons that make sense.
I know, but I'm just devil's advocating you.
Really?
Yeah. And if you get 6%, it'll last you forever. It'll last you for 20 plus years, probably 25 years.
Yeah.
But
there's no guarantee the next 5 years. I mean, next 20 years either. We don't know.
What I'm saying though is if you're gonna just put it in a bank account, Tom, if they were going to take it out and just put it in a bank account.
No, that's what I said. Properly invested.
Yeah.
Yes.
If you just put it in a bank account or even a high yield savings account, you're better off taking the $250 a month. And
I will add one other. If you're not comfortable with the stock markets, the ups and downs, the volatility, 1 year's worth more, 1 year's worth less, you're just not familiar with that, you don't like it, then I would take it and put it in a high yield savings account or CD or something like that. I mean, take the monthly amount. I would just take the monthly amount.
Yeah.
Because if you don't want to deal with it. Right.
If you don't want to deal with it, take the monthly.
Yep.
If you could invest it in a 60-40 portfolio, which would typically have returned probably, I don't know, in the 7% range in the past.
Yeah, that's probably safe. Sure.
Then that money would last you for the rest of your life. And if you died early, your heirs would get something. And that really is the bottom line. If you die earlier, you're better off with the 37. If you live longer, you're better off with the 250. Which are you going to do? Do you know? Bet not.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Welcome back to the Talking Real Money radio show and eventually podcast. Hi, everybody. I am Don McDonald in Florida. Over there is Tom Cock in Seattle, sort of, kind of, maybe Duval. And we'd love to talk with you about money at 855-935-8255, 855-935-TALK. So give us a call. I noticed we do have, yes, looks like all our lines are officially open, yes.
By the way, I'd appreciate more World War II references because the 80th anniversary of VE Day just occurred a few days ago. So? Victory in Europe, 80 years.
So?
I just, okay.
It was 80 years ago. You weren't here then.
I know. But my old man was there. He was fighting his way through.
He was flying bombers. My old man was too young.
Yeah.
My old man.
Now you're really going to try to hurt my feelings.
Much younger. 855-935-TALK is our phone number. So call us with your questions or send them in to us at talkingrealmoney.com. And sometimes people just ask us questions and we go, like clients and things. And we go, oh, that would be a good question for the show.
This just came up in the hallway recently. By the way, this is somebody who came to a retire meet 6 years ago and said, we just love retire meet. We got to go back again. They quit going after COVID. They kind of lost track of it. But any rate, they were asking me. They have a 24-year-old daughter who's just starting out, right? Mm-hmm. First job, saving some money, et cetera, et cetera. And the question was, does it make more sense to crank up the retirement savings, or conversely, because you can't afford to do both, they said,
right,
save for a house, a place to live? It's a great question.
It's a great question. I have to tell you, my youngest daughter decided to go with the house.
What?
She did. She bought a townhouse.
You never told me this.
Yeah, she bought a
townhouse. That was the one in Florida.
The one in Florida. Well, that's when she was in her early 20s.
That's right.
And
because everybody gets rich with Florida real estate.
Hate to say it, though, her timing was impeccable.
Right before
the big run up, the COVID run up, and all that. I mean, she did really well. But generally speaking, so I don't want to sound like a hypocrite. But generally speaking, I think it makes the most sense to max out those retirement savings vehicles, particularly the Roth, the tax-free baby. To max that out and aggressively invest that money, even if in 5 or 10 years you have to switch to afford the nicer home when you have a family. Because the thing is,
you have all those years of compounding. People forget that.
And the thing is also, when you're young and single, living where you live is a lot less important than when you're older with a family.
And your lifestyle could change a lot, right? If you meet somebody,
you
et cetera,
can rent
et cetera.
cheap and save more.
Yeah, and there's all kinds of online calculators where you can go put in 10 years of savings. Say you set aside $2,000, $3,000, $4,000, $5,000 a year, and you invested properly, which should be basically in a diversified portfolio of stocks. I don't know that I'd want you to own any bonds in your 20s. And then if you did nothing again after about age 30, but you just let that grow for the next 30 years, you're in a wonderful place. So I don't think there's much of an argument here on this one. I really think the housing should be lifestyle. The saving for retirement is really going to be a great financial move for somebody in the 20s. And by the way, you don't have to wait till you're in your 20s. You could do this with a kid who's got any income. Start that Roth IRA and start cranking that up when they're setting anything aside there. So it's a wonderful opportunity.
Literally, we mean anything, any amount. If they've got some sort of earnings, then they are well on their way to a very, very comfy future. Very comfy. And it's so funny that we run a lot of numbers where you could just do it for 10 years and then stop.
Yeah, I know.
And just let the money in your retirement compound. You don't even have to save anymore, and you're still going to be okay. You're going to be a whole lot better off if you keep saving, but you'll still be okay.
So we think that's an easy answer there.
Oh yeah, it's a no-brainer. My daughter's just a little bit different than.
They're all a little different.
A little different in one way.
Just the nature of the whole thing.
It's the nature of the child or the children. Remember our number. It's 855-935-TALK, 855-935-8255. It is so easy to be a part of what we do, and we invite you to be a part of it. Please give us a call, 855-935-TALK, or ask us questions online at talkingrealmoney.com, and we'll have more questions coming up, but every once in a while, we do have to take a little break, like, well, maybe now.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
It's your money, and therefore it's important that we and you talk about it. 855-935-TALK is our phone number, 855-935-8255. And let's go out to Indianapolis, Indiana. Kyle, it's your turn. Welcome to the show.
Hey, Tom.
Hi, how are you? I'm Don.
I've got a question
Tom's
for you
the other
guys. Got a question for you guys. Got about $40,000 that I've gotten from a vehicle wholesale and leftover money. Not real sure what to do with it. Don't really have any plans for it. Don't really know where to kind of put it. If it should go into like a VT or an AVGE and just kind of let it go.
Okay, but so what? This is long-term money. This is money you may need in a few years. Tell us more about the purpose of this money.
Don't really have a purpose for it. It's kind of don't really know where to go with it. It's just kind of extra. Don't need it for vacations or retirement. Currently, because I'm only 35. Don't need it for the monthly budget, and then got some other funds that flow into monthly budget and then vacations. So just kind of looking to where to park it for another 5 to 10 years.
Okay, 5 to 10 years. Now, you just said something important there you had not shared with us previously. So if it were 5 years, I would be very cautious about putting anything in stocks, because you mentioned AVGE, which is a global diversified stock portfolio, or VT, the same thing offered by Vanguard. If it were 10 years, yeah, I might have some stocks and some bonds. I might have a balance between stocks and bonds in that case if I was going to be pulling the money out. If truly it was forever, just going to go away and we'll see you, when I get to be 65 instead of 35, I would I would put it all in one of those globally diversified portfolios, and the two that you offered up are good options. Don?
Yeah, I couldn't, there's nothing I can add to that. It really has a lot, first its time frame, then its need and inclination and tolerance. And if it's an absolute got to be there in 5, there's just too much risk of a 5-year downturn in the stock market. It could happen. I don't know if it's gonna, but I do know it could.
Yeah, and I don't currently need it because we end up with about $10,000 to $15,000 a year of excess out of my yearly income that we don't use anyway, and that's kind of where this has been. Is just kind of the last year stockpiled in it with proceeds that we didn't use. I'm just kind of sitting around and don't really know where to park it with.
And there's another qualifier on all of this, and that is, in addition to the tolerance and the time frame, it's the need. How much risk do you need to take? Because is the growth of this likely to make a big difference in your future life, and you don't mind the risk to do that? Or you're so set, you don't see any great needs down the road. Why bother taking risk when it isn't necessary?
Yeah, because I've got about 30 in a 6-month emergency fund on top of this. So it's just kind of extra that's kind of sitting around. It's a good problem to have, kind of looking where it should go. But
are you both, because you mentioned another person, are you both, fully committed to your retirement plans? Are you maxing out your Roth or doing the backdoor? All those things you could be doing for the long-term future, are all those being done?
Yes, the Roth got maxed out in January, and we have money that should be set aside by November to max out the Roth, and the 401k is right around maxing out every year. So we're contributing about 35% of our household budget for the year.
Wait, a third of your money is going into savings? Yeah. A third of your money is going. You're just bragging now. Stop it. Come on. That's
Show off.
Over the top.
Yeah,
Jeez.
Household income is about $90K, and we save about 35% of that.
You're a great person, Kyle. Well done.
Well, great person. He's a good saver. We don't know that much about him.
Well, okay. You're a great financial person. How about that? Is that okay? You're good with your money. No, again, if it was between the 5 or the 10, that would make a difference. And then again, if I was trying to figure out, well, in 10 years, what could it be for? That would also determine how it was invested as well. But I think you're on the right track.
Does that help at all? I know it was very vague,
I
but
go for,
we can't tell you exactly anything. We wish we could.
Yeah.
All right. Well, thank you so much for the call. We really appreciate it. 855-935-TALK is the phone number, 855-935-8255. And Tom has another one of those questions that was sent in at talkingrealmoney.com.
And you simply click on
Contact us.
Contact.
And then you
Contact,
type it if you want it like this. You
Yeah.
speak it if you, whatever.
Yeah. All right. This comes from Allie in Lovell, Wyoming. I don't get a lot of questions from Wyoming, so glad to hear from Wyoming.
There aren't a lot of people in Wyoming.
Well, there's that. Okay. Let's not insult anybody else.
No,
we pretty much worked our way around the globe.
There aren't a lot of people in Wyoming.
I already had to apologize to the guy in Iowa last week.
How many U.S. representatives does Wyoming have?
I'll say one.
One is correct.
Yeah. Okay. Thank you. Hi, Don and Tom. A guest on the Paul Merriman podcast recently advocated for VTI plus VXUS instead of VT. Now, VT is a one fund globally diversified portfolio. VTI is the international, right? And VXUS is the U.S. Do I have that backwards? Anyway,
I think you have that backwards.
Between the two of them, you get the global. But he said the reason why is VT doesn't have at least 50% of foreign holdings, and thus when you go to cash it out, it won't get the IRS's foreign tax credit.
That's not why.
Instead, foreign countries might take a cut first, sort of a tax at the source called foreign tax withholding.
Yeah.
Question:
That's the
is
tax,
this true?
That's the tax
How much
scale.
we were talking about, et cetera, et cetera.
Okay. It is true. The foreign tax credit, it's not ginormous.
I don't think it's that big.
It's not. That's why, again, it's a tax tail wagging the investing dog again. However, the point was great up to the tax thing. Tax thing's just a bonus.
But that's the question, is the whole tax thing.
No, it isn't. It's the 50-50 capability.
We're back to how much in U.S., how much in international.
Is that I don't think it's the proper. I think we should. Many, many years ago, the U.S. and international split was 50%.
Yeah.
Either way. And just because the market has changed, if you had been a rebalancer all of that time, you would have constantly rebalanced back to your 50-50 split.
You'd have been selling U.S. stocks and buying international stocks.
I would rather see closer to a 50-50 split.
Then let's go back to 1990 and you put a third of it in Japan. 38%.
It was not a third of the.
I think it was.
No, it wasn't. It wasn't.
It was the biggest. It was the biggest global market in the world. I know that.
Yeah, but no, I'm talking about U.S. versus broad international.
Yeah,
I mean, really, when you look at it, we're not on a market cap basis, but on a industrial productivity basis, on the size of the economies. For example, the size of the globe, the rest of the world, in terms of GDP, is very, very close to what we are.
Okay.
So it's not just a market cap.
So this is, by the way, for those of you who are tuning in the first time, this is a difference between what Don says and what we do. So if you came to us right now, we'd be investing you 65% U.S. and 35% international.
60-40, personally.
Yeah. So there you go. But anyway, no, I would not make this change based on the foreign tax credit situation.
No, I would not. I agree with that.
I was just trying to remember last time I really paid attention to that on my taxes because I don't know. Well, I don't sell much stuff, but anyway, no, that would be a big no. And thank you for listening to us in Wyoming, where those long winter nights can be a bit lonely, I imagine, too. So.
And the phone number here is 855-935-TALK, 855-935-8255.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
The U.S. accounts for about 27% of the global GDP, the entire GDP of the planet, gross domestic product. If you take out emerging markets and China's a very huge
which is part of emerging markets, by the way.
Right. You take out, because China's the second biggest GDP in the world.
Then you got Japan and Germany.
So
I think, after that,
take that out. You really have, when you look at GDP, which I think, honestly, if I was making the rules, I would say it's your value as an economy in the world. That's why I come closer to that 50-50. I don't think it's an exact number. I just think it makes sense, particularly in an environment. This is kind of like Buffett think. In an environment where global or international stocks have not done anywhere near as well as U.S. stocks.
By the way, we just need to clarify now that he's talking about the economy. He's not talking about stock valuations, very different things.
Because I think stock valuations are not indicative of economic valuations.
We get all kinds of arguments here, by the way.
Stock valuations get all out of whack based on emotion.
But I think Fama French would argue with you. But that's a whole other. We're veering. But
I want to get him on and argue.
If Gene Fama argues with you, you're okay.
Of course,
with that?
I'd take him on. So what?
I wouldn't. I saw somebody do that once 5 years ago, and it was frightening. Somebody in the back of the room, I said, this is suicide. The guy's going to win it. I knew then he was going to win a Nobel Prize. Anyway, the point is, number one, you got to save something. Number two, you got to invest it. Number three, yes, you should be globally diversified. You could get into great debate after that about how much big or small or value growth or U.S. international, all those things. But it's an interesting debate. And, as we said,
and as a matter of fact,
agree to disagree.
The only reason that Gene Fama suggests a higher percentage in the U.S. is because of the power of the dollar, that the fact that we live in a dollar-denominated country.
At the moment.
Well, no, but we live in a dollar-denominated country.
Well, you're right. I'm saying globally. Anyway, that's a whole other silly.
But he does believe you need to have money in international.
Yeah, he does. So, all right. So take advantage of that knowledge that we're giving you, and there's several things we offer in addition to this radio show, podcast, et cetera. First of all, happy to answer your questions anytime. And by the way, Don, my grandsons and I love the Friday podcast. We never miss it together. And they get kind of mad if they get in the car. Yeah, they get kind of mad. They're like, what happened to Don today? Anyway, so if you'd like to ask a audio question, you go to talkingrealmoney.com, click on, that was your cue. Click on.
Oh, I didn't know it was a cue.
I was trying to point at you there.
Click on the contact button.
And then you can record a question. Number two, you can always call this show when we're live on Saturdays. Number three, if you want some additional help, and man, it's been fun talking to so many people. Talked to a great guy yesterday in Georgia. Talked to some people the day before in Virginia. Anyway, you simply go to talkingrealmoney.com, click on Meet an Advisor. And I'm going to meet some people at our Lake Oswego office here in
30.
Loving that. So take advantage of all that. We do a free analysis of your portfolio, talk to you about your financial planning, all that stuff. What do you always say? It's free. We don't put any sales pressure on you, et cetera, et cetera.
It's totally free.
Yeah.
We're not expecting anything out of you. Therefore, you should not expect anything like a sales pitch out of us, because we're not going to do that.
Out of us. You scared me there for a moment.
No, you should expect
there's some great information we provide. Okay.
I know. Well, no, because they worried about, pressure.
It's frightening. I agree. Who wants to talk to their financial guy? Because they're going to sell you something.
It's time we're done. Stop.
TalkingRealMoney.com.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.